So the requirement of the collateral security may vary. And depending upon the type of loan, even take for example, particularly while giving any loan to the company, the vehicle loan, we will ask company buildings or a company, any land and land is available, we will mortgage as a collateral security. So that's why the collateral security is useful to the bank. Otherwise, today, if banks are taking only primary security, then they may not survive. The loans will turn into bad. Today, we are security creditors. Banks are security creditors. If security is available, once security creditors are there, in the waterfall mechanism also, under IBC, the priority is there. Unsecured, next to the security creditors. So, in the appropriation of payments, or in case of liquidation, or in case of a waterfall mechanism, security creditors are the second stage after the CIRP costs. The requirement of collateral security may be varying depending upon the type of loan and the perceived risk associated with the borrower ability to repay. While some loans may require collateral, others, such as a microcredit or instant loans, may not have the collaterals. Particularly banks, small loans, even MSME also. Sometimes we are not insisting up to certain limit for MSME loans. Even startup companies, now the government of India is also encouraging. We are not taking any collateral security for the startup company because the idea is very, very important in startup company. The idea to be crystallized, the idea to be encashed. So that's why in startup companies, we are not insisting. Examples of primary and collateral security. Take out a business loan of 40 lakhs to purchase a new manufacturing equipment for your factory. The lender requires a pledge of the equipment of the primary security. This scenario, machinery being financed as a primary security for the loan. And examples of collateral security. Need funding to expand your business operation to seek loan 1 crore for the financial institution, while the new office building you plan purchase is a primary for the loan and lenders additional assurance. As a collateral security, you pledge your existing warehousing property, which is outright to secure the loan further. In this case, office building represents the primary, while the warehouse property act as a collateral security. So being a IP, whenever the financial creditors are submitting their claims, you have to classify whether it is a secured or unsecured. Even in the secured also, you have to open 2 columns. What is the primary security? What is the collateral security? Whether the collateral security is a company's property or other corporates or the directors of personal property or not, that is also to be classified properly. Because anyhow, you are going to submit to the NCLT about the list of claims and the segregation of claims, the secured or unsecured, and what are the rejections, why you are rejecting, all these total information to be provided to the NCLT. Why collateral security is needed? Collateral is essential to specific loan scenario, bolster lender confidence and mitigate the risk of default. While loans in housing or factory loans, typically secured assets, they finance such as a property or mission, collateral security become necessary in cash loans. Particularly working capital, it is as good as a cash loan. He is withdrawing, he is depositing, he is withdrawing, he is depositing. Thereby, the collateral security is compulsory. The cash loans, where the borrower defaulter could be lead to asset liquidation. Collateral security in the form of immovable property provide a additional layer for protection of the lenders, ensuring loan security and repayment even adverse circumstances. So that's why the collateral security is very, very, very important. What are the collateral free loans? Sometimes the bank is also not taking collateral, only primary. That is a emergency loan. Government of India, on account of pandemic COVID-19, they told you give 20% on the limits to all the industries. Don't insist any conditional. Whatever the existing is there, that extent. If not sufficient, leave it off. Like a CGT, credit guarantee, trust, MSME, MSC is there, micro small enterprises, without collateral requirement. Whenever we are giving loans under a CGT, MSC, we are not insisting any collateral. That is the direction. In case the loan is failed, they will pay the amount. For that, yearly we have to pay the premium for them, aiding enterprise growth. Why? Because if at all I insisting, the enterprise growth will not happen. They enhance the accessibility of the micro, small businesses, simplify the loan processing and promote entrepreneurship. While possessing higher risk, lenders credit guarantee schemes mitigate this risk. So the credit risk will be mitigated by the guarantee corporations. And this policy resolves funding the challenges and encourage the economic development of the country. That's why we are not taking the particularly collateral in certain loans. If government is given guarantee, sometimes for certain sectors, the government is also offers a guarantee. In that case, we don't take any security. Government guarantee is sufficient for us. That is ultimate. To safeguard the advances, the banks accept different types of security during the lending and create charge upon them. When land and building and fixed assets are permanently fastened to the earth or offered as a security, is charged as a mortgage in favor of the bank. Whenever the collateral securities are offered by the borrower, particularly the land and building, it is a fixed asset that are permanently fastened to the earth. That's why we are taking as a mortgage. Immovable property, normally for immovable property, we are taking mortgage deed. For immovable property, we are taking mortgage deed. When movable goods are offered security as a collateral, either pledge or hypothecation. In the pledge, the asset is with the bank control. The possession of the asset is in the banks. Hypothecation is the possession is with the borrower. So stocks, normally hypothecation agreement we will take. Take for example, gold loan. The possession is with the bank only. The gold with the bank. Gold loans are called pledged loans. Paper securities are also there. Collateral security need not be land and building, need not be plant and machinery. Paper securities are also there, like NSCs, National Savings Certificates, or gold bonds, etc., etc., or other company shares, other company investment by the company in other companies. Whatever the investments are there, that is to be assigned or marking lien to the bank till the loan is repaid. Charges on the securities. Particularly the word charges mean the security or the debt under section 2 subsection 16 of the Companies Act to provide the following charges of the company to be registered with ROC. Whenever we are giving loans, simply for companies, again we have to inform to the ROC. That is under section 77 of the Companies Act. That is called creation of charge. Once I have not created charge, that loan is not charged properly in favor of the bank. So, security or debt is defined under section 2, subsection 16, subsection 16, 216 of the Companies Act 2013. The charge on the debentures, the charge on uncalled share capital, and the charge on immovable property. Immovable property. Charge is to be created. If at all the bank is asking uncalled capital, you give the charge means the company has to give as a collateral. Or if at all the company is having debentures, debentures are also floating charges there. Debenture holders are also having charge on the debenture holders are having a charge on the company assets, a floating charge, and immovable property. Also, the floating charge is there. Now we will discuss in detail. The charge on book debts of the company, that is possible. The book debts means debtors. Now coming to most of the insolvency professions, I am observing, this is my personal view only. When in the balance sheet, plant is there, land and building is there, and physical properties are there, definitely they will target. But at the same time, the debtors, that is a potential asset. The debtors means credit sales. The debtors means credit sales. Once the credit sales are there, and they have taken the stock, they have taken the goods, or they are availed the services, and they have given bill of exchange to the company, why we are not targeting on debtors? Okay, today also some NBFCs, they are ready to purchase debtors. And even factoring services. Factoring means once the company debtors are there, we can sell it to we can discount with the factoring, or selling to the factoring also. Selling to the purchaser by the factoring is called forfeiting. Debtors also purchased by the factoring companies. That companies are called forfeiting companies. Suppose I have exported the goods to other country. I have exported the goods to the other country. Then the buyer not paid, it is reflected in the balance sheet. That is a foreign credit. The profits are to be received by me. I have given, I am the seller, the buyer is a foreign importer, I am the exporter. Particularly forfeiting facility offered by some nationalized banks and Export-Import Bank of India also. Export-Import Bank of India, they will purchase with a discount based on the creditworthiness of the buyer, based on the whatever the acts that are prevailing in that particular country. And so many the conditions are there. All these are studied and they will arrive the discount. Okay, this 100 rupees debt I will purchase for 60 rupees or 50 rupees like that. So in case the company is unable to recover, the company requires some funds. That is called interim finance. The interim finance, one source is selling the debtors. Selling the debtors. That is interim finance. Floating charge on the undertaking on any property, including stock in debt. A charge on ship or share in ship, or a charge on goodwill or patent or a trademark or license under copyright. So all these things are there. So charge can be created on the company assets, particularly whatever the assets are there, that charge also can be created. Chapter 6, section 77, subsection 1. It is a duty of every company creating charge within or outside India on its property or assets undertaking, whether tangible or otherwise. Intangible loss. Intellectual property rights, intangible. Goodwill, intangible. Patents, intangible. Situated or outside India, to register the particulars of charge signed by the company and charge holder together with the instrument, if any, creating such charge in the form of a payment of such fees and such a manner as may be prescribed with the register within 30 days of its creation. So whenever the lenders are giving any loans to the companies, the charge is also to be created as per section 77 of the Companies Act. Provided the registry may make an application by the company, allow such a registration to be made within 300 days of such creation, payment of such additional fees may be prescribed. The maximum period is 300. Beyond that, they don't. Creation of charge. Creation of charge by the borrower on various kinds of securities and assets for creation right in the favor of the bank. By creation of charge, the ownership is not transferred in the favor of the creditor, except a few transactions, that is English mortgage. Ownership is not transferred. Ownership is in the name, but charge is created. In case the failure is there, then he is having a right to recover the amount through the sale proceeds of that particular asset. Types of charge. There are two types. Fixed charge is there, that also called specific charge. The fixed charge is there, that is also specific charge. It extended over the specific property of the company, and it gives a right to the creditor to sell the property and claim the process toward the dues payable by the company. So it is a created property such as land or building or plant or machinery whose identity does not change during the period of loan. That's why it is called fixed charge or specific charge. Floating charge. The charge assets are changing. Today I have purchased raw material. Tomorrow I manufactured, and the day after tomorrow I sold. Again I am purchasing raw material. So this on stocks, not fixed charge. It is a floating charge. Whatever the bank originally given stocks, the same stocks are not available. Not available. So that's why the fixed charge is there. Floating charge is also there. Floating charge means on the floating assets. Example, debtors, I am having floating charge. Today debtors maybe differ from after 3 months debtors. Old debtors repaid and new debtors created. That's a bank will take or charges to be taken on floating assets, floating charge, not fixed charge. But a plant and machinery, land and building, that is a fixed. That's why it is called fixed charge. Floating charge. This means the charge is a general, not specific. It is created on the assets which are undergone change, like stock. Floats over present future property of the company. And it did not, do not attach any specific property. On happening of an event or contingency, crystallizes a fixed charge. Once the company is defaulted, floating charge is converted into fixed charge. Earlier, I have taken a floating charge on the stock. Once the company is defaulted in repayment, then the stocks, earlier it is a floating, now it is a fixed. I can seize and sell in the market. So on default, the floating charge will be converted into fixed charge. On the happening of an event or contingency, it crystallizes as a fixed charge. The floating charge is a equitable charge, which does not any specific property, but covers the whole of the company's profit. All floating charge on company assets means whatever the assets are there, all will be covered. So the floating charge assets will be converted into fixed on the occasion of non-payment of the loan or any contingency or crystallizes. It crystallizes. Crystallization charges. It means floating charge becomes fixed when the company firm ceases to be going concern upon the commencement of winding up of the appointment of the receiver. Once the company is defaulted or once the company is in liquidation, the floating charge will be converted into fixed charge. Again, charges are also to be created. First charge, second charge also. Charges are also to be created. Suppose I am having a 50 crores property. I approached State Bank of India for 20 crores. They have taken a 50 crores of property, land and building, and given 10 crores or 20 crores. Again, I approached Punjab National Bank. I asked Punjab National Bank that State Bank of India have given 50 crores. I don't have any other property. On the same property, you give me 10 crores. First charge in the name of State Bank of India on that property. Second charge is created on Punjab National. As long as the gap is there and banks are also interested, there is no problem. First charge. Where the assets are charged to the creditor first basis, the creditor has first charge. Where the assets are already charged to the creditor on the first basis and subsequent charge is created in favor of another creditor, that is called second charge. So in CIRP process also, you have to look into that. Particularly the secured creditors, secured financial creditors. What is the property value? What is the first property, first charge holder outstanding? And if at a leftover is there, the second also you can take as a secured creditor. If there is no, here also you can split into, suppose one asset is there, 30 crores. The present valuation and the insolvency commencement date. Insolvency commencement date. You have valued that asset. The value of the asset is 30 crores. And on that asset, two charges are there. One is the State Bank, second one is Punjab National Bank. And the State Bank of India, the borrower taken 20 crores and defaulted. And on the insolvency commencement date, the particular loan amount is 22 crores. 22 crores means whatever the leftover, 8 crores. The Punjab National Bank given another 15 crores. So the Punjab National Bank security available is 8 crores, unsecured portion is 7 crores, like that. So while preparing the claims statement, that is claims statement, secured or unsecured, all these things you have to mention clearly. Why? Because it is useful in the liquidation. It may be useful in the information memoranda also, while providing that information to the prospective resolution applicant. Pari passu charge. What is meant by pari passu charge? Equal rights. Today, most of the loans are pari passu charge. Most of the loans are given by the bank under consortium advance. The asset is common. The loans are loan is contributed by member banks. Either it may be the 5 or 10. Based on the share of the loan, they are having a right on that particular property. Suppose I take, for example, the property value is 100 crores. And one bank is given 20 crores, another bank is 20 crores, 30 crores, another is 10 crores. So that 3:2:1, that is a share of that particular 100 crores property. So 100 into 2 by total 6, 3, that is a portion. Second one is 3 by 6, 2, or 1 by 6, like that. So here paripasu means equal rights. Equal means not divided by 3, depending upon their loan exposure. Depending upon their loan exposure. The term usually used in the case of consortium lending. In case of such lending, many banks or financial institutions join together to lend a single borrower in an agreed ratio against some common securities. The securities are charged to all the bankers' financial institutions with the condition that they have priority on the proportionate basis ratio in their loans. The term institutions have pari passu charge over the assets of the borrower means that the lenders are entitled to equal rights over the assets as per the agreed share. That is the pari passu charge. Pari passu means equal. It doesn't mean divided by 2 or divided by 3, not like that. What is the loan percentage in the total loan? Accordingly, the security value. So these things are very, very important in arriving the statement, particularly the statement, the secured or unsecured creditors, like that. Registration of charges. Today, charges are to be registered with the various authorities. That is common. After creation of charge on securities, charges must be registered with the appropriate authority as applicable. First, you create the securities, creation of charge. After that, you have to register with the appropriate authority also. Charges are to be registered with the RTO, Regional Transport Officer. When the company is going for the financing the vehicles, whether school buses or proclaims or bulldozers or so many things are there. The companies, infrastructure companies. Suppose the bank has given loan 20 crores for a school. School buses are there. And a bank has given loan for the medical, particularly the pharma. The staff carrying buses are also there. That is also funded by the banks only, if they require. But whenever we are financing equipment with the appropriate authority, we have to create charge. Thereby, the asset is not transferred by the borrower to the others. Suppose today I'm giving a number of loans for car loans. Suppose the car loan I have not registered with RTO, the regional transport officer, the hypothecation to State Bank of India like that. Immediately the borrower, he will execute the sale deed and submit in the RTO and transfer the vehicle to others. Once the hypothecation to State Bank that charge creation is happened, definitely 100% it will not be transferred to others. Like CIRP. Yesterday also told about CIRP. CIRP was introduced under Surface Act of 2002. It is a central register. It is a central registry. What I told is yesterday also. One borrower, he availed a bank loan from 27 banks with the same title deed. Then the Reserve Bank realized and told that this is a big, this is a fraudulent transaction. 27 banks. 27 banks, then they strictly implemented CIRP. Once the property particulars are entered in CIRP, then it is available in the central registry. And if other bank is financing to that particular, the borrower take a number of duplicate title deeds. Today, if you pay 1,000 or 2,000, they will give 5 copies or 10 copies of the sale deed registered with SROs, sub-registrar office. And the borrower visited to the other bank. Immediately the other bank earlier, before CIRP, there is no checking. Blindly believe the borrower's version and they will create equitable mortgage. First one created equitable mortgage, second one created, like that 27 created and given the loan. But now today, that is not possible. Why? Because once it is created in one bank, if we approach a second bank normally they will verify through CIRP, the title deed and other particulars. Then automatically some information will be displayed. This loan document already mortgaged to XYZ bank and taken a loan of so. The full particulars are displayed. Thereby, the duplication finance or double finance can be averted or avoided. And as you know pretty well, Section 77, we have to register with the ROC also within the prescribed period. All mortgages and hypothecations shall be filed with the CIRP within 30 days of creation. Like ROC, 30 days. Here also 30 days. If it is not 30 days, then the per day penalty is also there. Initially, the government is not strict in charging, that is Government of India. I mean, CIRP is the owner of Government of India. They have not strict. Today, they are very strict. Within 30 days creation. All the charges created by the company with ROC within how many days? 30 days on. CIRP within 30 days. After that, per day 500 penalty. So that's why now the banks are alert. Once the equitable mortgage created for a property, immediately they will enter into CIRP also. And once a CIRP is not entered, then the penalty to be recovered from the staff members. That type of the that type of this one is also there. All charges created by the company shall be fixed with ROC within 30 days of case. The registration, the modification, the satisfaction of the charge to be filed with particularly CHG1, CHG4 in MOC, Ministry of Corporate Affairs 21st century. So charges to be created with CIRP, charges to be created with ROC within 30 days, and the charges for ROC, the various forms are there. The registration, modification, satisfaction is there. That numbers are, that forms are also available in the Ministry of Corporate Affairs, that is a register of companies. And we have to, both the borrower as well as the banker, they have to fulfill that condition. Ministry of Corporate Affairs charge filing fees new structure. That is also modified. Within 30 days, no normal fees. Up to 30 days and 6 times the delay up to 30 days, 6 times of the normal, and the delay more than 30 days or up to 90 days, 6 times normal fees plus ad valorem based on the value of the property, that 0.05% amount and a maximum of 5 lakhs. 120 days and above, charge will not be undertaken on record by the MCA. But recently, some modifications were also happened in this regard. Please refer MCA, the circular in this regard. Effect of non-registration. As per Chapter 6, Section 78 of the Companies Act, where the company files a register to charge within the period of Section 77 without prejudice to its liabilities offense under this chapter, the person whose favor charge is created may apply to the register for registration of charge along with instrument created for charge within such time. Such a form, manner may be prescribed by the registrar. May application within 14 days after giving the notice of the company. So the non-registration, what are the consequences of a non-registration? So chapter 6, Section 78 of the Companies Act deals with the effect of non-registration. Where the company fails to register charge within the period of stipulation, that is 30 days or whatever the stipulation, maximum is 300 days, without prejudice to its liability, respect offense under the chapter, the person whose favor charge is created may apply to the register of companies along with instrument created charge within such time, manner prescribed. On such application within 14 days after giving the notice to the company. If the charge created is not registered with ROC, the charge would not be valid against the liquidator and any other creditor of the company in the event of winding up the company as per the company itself. So that's fine. Whenever you are adopting or implementing that a particular preparation of this one, secured or unsecured, you please verify this one also. If a charge is created is not registered with ROC, the charge would not be valid against the liquidator. and the creditor of the company in the event of winding up as against the company itself. So long as the company does not go into liquidation, the mortgage or charge is good and may be enforced. So that is a must. The financial creditors are ensured once they are filing the application with the NCLT, before that, whether the charge is created or not. If not, create that one. That too, so long as the company does not go into liquidation, the mortgagor or charge is good and may be enforced. But once it is in liquidation, after liquidation, if at all you are asking about charge creation, that is not acceptable. You don't have the validity, not be valid against the liquidator of the creditor of the company in the event of winding up the company against the company itself. Different types of securities, charges related acts as under. Immovable property. If you say a land and building, always it is immovable property mortgage. Mortgage is covered under Transfer of Property Act 58. Auctionable claim, that is unsecured debts, book debts, or FDRs, or NSS life policy. That is a charge is assignment. It is also transfer of property, section 130, 135. Mobile property, particularly the stock or plants, some machinery, mobile goods, pledge or hypothecation or lien as agreed between the bank and the borrower. So sometimes it may be lien, particularly the fixed deposits and others. Once a lien is there, it is covered under Companies Act, Contract Act. Pledge means Indian Contract Act. Hypothecation, it is defined in SURFACE Act 2002. Paper securities like shares and debentures, mutual funds, that is covered under lien only. Lien is under Indian Contract Act. Now we will discuss about the each and every aspect, particularly the mortgage. Any clarification, any discussion, sir? Sir, any clarification or any discussion on this aspect? Okay. If there is no, I will continue further. Mortgage. Mortgage is defined as a Transfer of Property Act under section 58 subsection A as per the Act. A mortgage is a transfer of interest of a specific, here also specific, it is not fixed, not floating. All fixed assets are subjected to the mortgage. Specific immovable property to secure the payment of money advanced to be advanced by way of loan, an existing or future debt, or the performance of an engagement which may give rise to pecuniary liability. So a mortgage is the transfer of interest and whatever the immovable property is there, that is secured a payment in advance, an existing or future debt. The mortgage is covered not only the existing and future debt also. Why? Whenever the banks are giving loan, the interest accrued over the loan, then automatically, or in future, if at all they are given any enhancement, that also covered. That's why in mortgages, banks are creating supplementary equitable mortgage, that is extension of equitable mortgage, or the performance engagement which may give rise to the pecuniary liability. This is defined under particularly Transfer of Property Act under Section 58, subsection A. The transfer is called mortgage. The transferee is called mortgagee. The principal money interest in the payment is called mortgage money. And the effect is called mortgage deed. Mortgage deed. Sir, here, whenever the mortgage is created in the registers of the particular register, equitable mortgage register of the bank, you have to ask when it is created, can I have the particular the information like that? Because sometimes the creation of equitable mortgage may be wrong. And the mortgage, equitable mortgage period of limitation is 12 years. After that, again a fresh mortgage is to be created. Otherwise, that is mortgage is stale one. So, whenever you are identifying that the person, financial creditor is secured or unsecured, the limitation period is very, very important. Particularly the documents. Documents are to be revived every 3 years as per the bank stipulation guidelines. Otherwise, it will become time barred. That too, as per section 18 and 19 of the Limitation Act. At the same time, the equitable mortgage also, the period of limitation is 12 years only. One loan is there. One loan is there. They have given loan, the installments are not, as long as installments are paid, the mortgage deed is not to be revived. If installments are not paid, then it will be a problem. Because the limitation period will start from the date of the non-payment of the installment. Normally, the period of limitation for equitable mortgage is 12 years. If that is not happened, that fresh mortgage not happened, then the mortgage is not valid. Then you have to classify him as the particularly the unsecured creditor. Interest in the property and possession. The mortgager only parts with the interest in the property and not the ownership. The mortgage is not merely a contract, but it is a conveyance of interest in the mortgaged property. And as regards the possession, except usufructuary mortgage, the possession remains with the mortgager. Essential features of the mortgage, we also follow loan amount. Mortgages can be created, cover the general balance existing payments as well as the future payments of the advance. Relationship. There must be a creditor and a debtor relationship of the contract of the guarantee. Whenever the borrower is taken loan, the creditor and debtor relationship is there. The bank and the mortgage at the time of deposit of title deeds. Future debt also it will cover. Actual existence of the debt is not necessary. Even an application for debt is acceptable, establish the relationship also. Effective date. A registered mortgage on the equitable mortgage become effective from the date of mortgage. That is as per the Indian Registration Act 47 or 48. Enhancement of limits. Whenever the company is taking higher amounts than the earlier one, continuation is there. That is a supplementary registration we will take. The extension of equitable mortgage. We will continue the original mortgage, and any enhancement are there, we will create a extension of equitable mortgage. To cover the enhancement of the bank limits, supplemental registration deed is required because mortgage already does not cover the enhanced amount. That's why whenever we are giving additional amount, supplementary documents we will take, and whatever the existing equitable mortgage is there, we will take extension of mortgage. That's why two forms are there, Form A and Form B. Whenever the mortgage is created, the equitable mortgage is created, first the bank will get the opinion of the legal opinion on the title deeds. Legal opinion on the title deeds. Second one, the encumbrance certificate. For the last 13 years we will take, but mortgage period of limitation 12 years, the grace 1 year we will take on the same property title deeds, property or the property or the title deeds. Third one is whatever the property taxes are paid on that particular property, we will take. The fourth one is search report. The search report to be obtained by the search report to be obtained by that particular empaneled advocate from the sub-registrar office. He will visit and verify whether it is existing property or not. Otherwise, some properties, fabricated documents may be there. So all these things, beyond that, the valuation of the property also. And once all these things, the borrower has to come to the bank, he has to hand over the document, original document, but equitable mortgage, no Xerox copies, no duplicates also. Suppose in CIRP, one equitable mortgage created by the bank and given loan on duplicate. That as per the Registration Act, it is not valid. It is not valid. That is duplicates. So equitable mortgage should be done on original documents. If at all duplicates are there, then a registered mortgage, not equitable mortgage. Suppose the bank told that I have created a equitable mortgage like that. Can I have the original document? If original documents are there, no problem. Next, all these things are there. Then the bank has given the loan. And if at all any extensions are there, and not only this one, okay. Once it is documents are entered in the equitable mortgage register of the bank will give one form, that is a Form A. It is almost similar to all the banks. That is a confirmation of equitable mortgage. What is a confirmation of equitable mortgage? The borrower will mention all the particulars on that paper and send by registered post to the bank. Then only the mortgage is valid. If at all the mortgage is later on, the borrower may argue with coercion, with pressure. The bank taken away my original document and they have created equitable mortgage. I am not. That's why, with an intention to create with an intention, without any pressure, without any coercion, the documents are to be mortgaged. Then only it is valid. That's why the bank will give one Form A and prepare that one and send it by register post, and that Form A also to be entered in the equitable mortgage register. Then only it is valid one. So whenever this type of situations are there, you ask the EC, you ask the title deeds, or you ask whatever the search report, you may ask that particular receipts, and last one is the TIR report, and whether it is a original one or not. Last one is Form A is there or not. Sometimes the borrower may take a higher amount later on the same property. On the same property. Then what bank will give? They will extend that mortgage. Original is intact, and the extension is additional amount they will prepare, and in the extension they will. In that case, what they will do is they will give Form B. And the Form B, the borrower has to mention the original limit and later on the new limit and fill up that one and send by register post to the bank. Then only the extension is valid. So the Form A and Form B, the creation of mortgage, the confirmation of a mortgage letter is also required. If a confirmation is not there, that is not a valid the mortgage. Second one is Xerox copies, duplicates, or Xerox copies, title deeds on those the bank has created mortgage. That is also not correct equitable mortgage. Please check it up. This one also. The repayment of on the repayment of the mortgage does not remain valid. Once the loan is repaid, then the mortgage is invalid. Even though some banks they may give, they may not give the. Sometimes the banks will tell the documents are lost, like that. Okay. But here, once the loan is repaid, bank is given no due certificate. Whatever the equitable mortgage created by the borrower is not valid, not remain valid. Different types of mortgage. The types of Transfer of Property Act. Sometimes simple mortgage, mortgage of conditional sale, usufructuary mortgage, or English mortgage, or equitable mortgage, or mortgage of deposit of title deeds, or anomalous mortgage. These are the various types are there. Some banks, they will use the simple, most of the banks, they will use simple mortgage, or the equitable mortgage, or mortgage of title deeds only. So here, the definitions, the ownership, the personal liability of the part, this one, and a registration with the sub-registrar, or how to create a mortgage, all these things I have mentioned. Limitation period of the mortgage. The limitation period of the mortgage is 12 years. From the date of mortgage, money become due. You underline, money becomes due. That's why almost all mortgages are valid. Why? Because even though we are giving a loan for 20 years, as long as the borrower is continuously repaying the installment, from the date of default, the 12 years will start. So most of the mortgage documents are not getting time barred. And the right of the foreclosure, redemption is its 30 years. The details of the mortgage and overview is available in that this one. Now, we will take a break for tea for 10 minutes. Now it is a time for 34. 44, we will meet again. Is it okay? Sir. Now, another type of charge in the banking system. I have discussed widely about the mortgage. And mortgage is basically for immobile properties. And now we will discuss about assignment. Because various types of collateral securities are provided by the borrower for the existing loan or proposal loan, and different types of charges are to be created, and assignment is one type of charge. Hypothecation, equitable mortgage, registered mortgage, assignment, pledge, lien, 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 different types of charges creation is there. Some of the charges are to be registered with either RTO or ROC or CIRP. Assignment. As per section 130 and 135 of Transfer of Property Act, this is a defined assignment is a defined under Transfer of Property Act. Is a transfer of an actionable claim which may be existing or future as a security for the loan. Suppose you are taking some one in the simple for easy understanding. One individual applied a loan on LIC policy. LIC policy. Then the bank will ask, you go there to the LIC and get the surrender value of the LIC policy. After that, once the bank is ready to give, they will ask to assign the LIC policy in favor of the bank. Then whatever the nominee given by the policy holder earlier, that is cancelled. Once the policy is assigned in favor of the bank, there is no scope for the policy holder to cancel the policy. And the bank also, whatever the surrender value is there, on the surrender value, they will give 75% or 90%, depends upon their credit policy. Assignment. As per assignment, LIC policies are assigned. Like that, some securities, particularly the policies, assignment is also there. We will discuss about assignment. As per section 130, 135 of the Transfer of Property Act, assignment is a transfer of auctionable claim which may be existing or future as a security for the loan. Assignment is another mode of providing security to the lender banking. This is another mode. Different modes are there. One is a pledge, second one is equitable mortgage, registered mortgage, assignment. Assignment means a transfer of the right of the property as a debt to the existing or future, for the existing loan or the future loan. The borrower of the bank may assign the rights, properties of the debt banker to secure the loan. Once, earlier example, the borrower taken the loan, not paid. Then the bank informed to the LIC authority to cancel the policy and send the proceeds to the loan account like that. The borrower of the bank may assign the rights, properties, or the debt to the banker to a secured loan. An assignment also a transfer of auctionable claim, such as a life insurance policy, which may be the existing or future as a security for the loan. The transfer of such claims are called assigner, and the transfer is called assigning. The next, the type of charge on the assets given as a security by the borrower to the banker for availing the loan is pledge, PLADG. Pledge is defined under a Contract Act, Indian Contract Act. Under sections 172 of Indian Contract Act, pledge is a bailment of delivery of the goods as a security for payment of the performance of the promise. It may be remembered that only goods or movable assets, excluding auctionable claims of the sale of goods, can be pledged. The bailer in the case of the pawn or the pledger. The bailer is the pawning or the pledgee. Pledge is different from the bailment. Bailment is a delivery of the goods from one person to another person for the purpose of the pledge is a performance of the specific promise or security for the debt. The pledge can also be sell the pledged after giving notice to the pledger, while bailment of the goods retained by the shoe. Particularly earlier, banks, while giving the working capital loans, particularly on stocks, the stocks are pledged to the so-and-so bank. Stocks are pledged to the so-and-so bank. So once the stocks are pledged to the bank, stocks are pledged to the bank, they will put lock and key. That is in the control of banks. As long as the loan is not paid, the bank will not give the keys to the particular bank. Earlier, in the banking system, the pledge is not a hypothecation pledge, particularly the rice mill or industries, wherever the stocks are there. The godowns are locked by the bank and properly sealed, and they will put security, and the bank is taking pledge agreement instead of after that some problems are there in pledge. That's why they shifted to pledge to hypothecation. Pledge to hypothecation. So the bill is in that case, what are the problems in that particular pledge? Because the bank has to take care of the pledged goods. It is a bailment of goods. And once the pledged goods are there, whatever the loss incurred, that is to be compensated by the bank. So in order to avoid all these things, banks are stopped the pledge while giving the loans on stock. Once the loan is paid, to that extent, stocks will be released. Particularly, this was happened in rice mills or food processing center, food processing industries like that. Today, almost all banks, they have not sanctioned the loans under pledge, particularly the stocks, only hypothecation. Only hypothecation. The owner of the goods or agent of the owner, joint owner, with the consent of a co-owner, and persons have a limited interest of the goods to the extent of interest can be pledged the securities. Pledged by mercantile agent. Under section 138 is the mercantile agent with the consent of the owner in possession of the goods. This is also happened in pledge, particularly in trade transactions. This type of the pledge is also happened. The pledger on poly has a limited interest as per section 179, where a person pledges the goods which has only limited interest. The pledge is valid to the extent of that interest. Suppose the 200 crores stock is there. Bank has given 10 crores. Only to the extent of 10 crores only they are having the right, not 200 crores. Duties of the pledge. Whenever the pledge of goods are taken as a security for the proposed loan or existing loan, to return the goods along with the accretion of the goods, if at all any benefits are there in that particular goods, that is given back to the borrower once the money is paid back by the pledger. To take much care of the goods which have been taken had been goods belonged to him. So that's why banks are not preferring pledge. Particularly earlier in pledge, it is a secured loan. Even today also, the gold loans are also secured loans. So the gold is with the bank. So he has to take much care. But in stocks means a big godowns. Say even though security is there, sometimes the theft and burglary will happen. The bank's rights and other duties. The bank right privilege prevails over the other dues, including government dues. Supreme Court of State of Bihar versus the Bank of Bihar, except workers' wages. Law of limitation. The pledge are not limited to the law of limitation. The rights of the pledgee are not limited by the law of limitation. Now, the prominent one, the frequently used, the one of the types of charges is hypothecation. Hypothecation is defined in the Surface Act 2002. As per earlier, the hypothecation is not defined. First time hypothecation was defined in the Surface Act. As per section 2, subsection N of a Surface 2000, hypothecation means a charge upon any mobile property existing or future created by the borrower in favor of the secured creditor without delivery, possession, mobile property to such creditor as a secured for financial assistance, including floating charge or crystallization, etc., etc. Today, the widely accepted the charge is a hypothecation. Whenever the banks are giving loans on stocks, hypothecation. Hypothecation, even now vehicles, hypothecation. The assets are with the borrower. He can use the borrower. The borrower can use the assets that is financed by the bank under the hypothecation clause. And as and when the borrower is defaulted, the bank is having a right to seize that particular the assets and sell it in the market. Hypothecation is an equitable charge where the borrower or the owner keeps the position of the security on behalf of the creditor. In a hypothecation on the property, the ownership as well as position of the security remains with the borrower. The possession as well as the rights are with them only. Otherwise, if the possession in bank, it is very difficult to manufacture the goods with the help of that raw material. It applies all mobile properties, stocks, crops, vehicles, machinery, furniture. Wherever mobile property is there, even not related to our IBC, even agriculture loans given by the bank, agriculture loans given by the bank is also we are taking hypothecation agreement on the standing crops. Whatever the crops are there, if the borrower is not paid, bank is having a right to cut the crop and sell it in the market and appropriate. That is not happening. But the hypothecation agreement clearly states about this one. Hypothecation is resorted in the following cases. When the loan is raised against work in progress, the only way creating charge is hypothecation. Once the loan is created on work in progress, semi-finished, the only way is even whenever we are giving, particularly the real estate, the cement, the steel, the paints, whatever the goods are there. When the bank is giving a loan to the builders for purchasing of this cement or steel or whatever the particular paints and other things, all stocks are hypothecated to so and so bank. Once the real estater not agreed the terms and condition, the bank is having a right to seize that hypothecated assets and sell in the market. It is also done concerning the goods that require constant handling in a factory, that is rice mills, oil expellers, etc. This charge is convenient. Bankers are also earlier for the same type of loan, banks are used a pledge, but problems are there. Security to be provided. Okay, the security costs are also to be borne by the borrower. Second one, if at all any wrong things are there, because it is almost a bailment of goods. If anything wrong things are there, then the borrower will claim on the bank. So why should I take this responsibility and all this? So use your goods by you and the possession also you, and give the insurance policy on that. This change is also convenient, where lending is done against the goods in a shop or showroom is required for day-to-day use. Particularly, we are providing the loans, the super bazaars or electronic goods. All people, they are availing this type of loans. But at the same time, they have to take insurance policy for the stocks. And once they have not paid, the bank is having a right to sell the property, seize the property and sell the properties. The goods, properties means goods. It is easily applicable for vehicles, private or commercial use. That's why even individuals also, whenever the banks are giving loan, car, hypothecation loan, banks are giving multiple vehicles, different types of vehicles to the corporates. For that also, the charge is to be, the hypothecation is to be created. Drawbacks in hypothecation. The main drawback and the charge is remains in the position of the borrower, and therefore creditors' control over such goods are not practically possible. Correct? Suppose I'm giving a stock loan. Stocks are with the borrower. He sell the stocks, close the entity, unit. Today, most of the IBC cases is on account of a failure of a repayment of that a particular working capital loans. If you see the financial creditor, normally financial creditor will provide 4 types of loans. One is working capital, second one is a term loan, third one is bills discount, fourth one is non-fund based business like guarantees or letters of credit. The diversion of funds will have is mostly in the working capital loans. Working capital loans. So the main drawback of the charge is the goods remain in the position of the borrower, and therefore creditors' control over such goods is not practically possible. The borrower may relax and sell the hypothecated stocks and keep only obsolete and slow-moving goods. Every month, some of the borrowers, they are submitting the stock statement. In the stock statement, they may mention only with regard to the non-moving or obsolete stocks. Good stocks processed and sell in the market and diverted that amount to others. So That's why yesterday also I told, in the Reserve Bank of India survey also, most of the fraudulent loans are in working capital loan. That too hypothecation. Because the possession is with the borrower and the rights are also with the borrower, and he sold that stocks and converted into cash and misappropriated that first funds. So once the company is incurring, they turn into bad means under what grounds? First, that is to be arrived. Any diversion of funds. That's why puff transactions, it is not simply verifying the accounts. Where the stocks? Bank has given 20 crores worth of stocks. Once the stocks are not there in the godown, where? If at all it is not there, okay. Credit sales, data also to be raised, data are also low. So diversion of funds may be there, or eating of the funds may be there. The borrower may be hypothecated the same stock for more than one creditor or banker. The borrower may hypothecate. This is happening in the bank, double financing. Even though we are clearly told these stocks are hypothecated to State Bank of India, they will remove the board and they will take a loan on the same stock from other banks. Today, that is not happening on account of the CIBIL reports. The CIBIL reports are also there. CIBIL reports means immediately they will cross-check that one. Even though they lifted the board, that is not a big task for the banks. If they taken the commercial CIBIL, their credit history reflected in the commercial CIBIL. The realization of the assets in case of default of payment is a difficult, prolonged, and costly affair also. Today, most of the cases, the immobile property is there only. It is very difficult to sell. Whatever the IBC cases are there, most of the cases are the working capital loans, default. Because it is a hypothecation that the possession as well as the rights are also with the borrower. So that's why this is one of the important area. Precautions to be taken by the creditors while loans given under hypothecation clause. Banks ensure the firm is not enjoying similar facility with other banks on securities. Today, even if full particulars are not available or account details are not available of the defunct firm which is undergoing CIRP process, to know how many banks they have enjoyed means the CIBIL report is the best one. That too commercial CIBIL. If you take all liabilities, only it is a matter of 1,000 rupees. You pay and get that CIBIL report and get the full particulars about the financial creditors. And the second one is charge created hours. That too is sufficient to get an overview of what type of loans he has taken. Borrower enjoys the facilities from one bank and undertaking in writing should be obtained from them. Even though we are taking low money things, still they are taking multiple banks. Even the working capital is in one bank, the sale process are routed through current account for another bank. That's why the Reserve Bank of India also, on account of this one, they have given stringent guidelines to open the current account. Once the company is having a working capital loan, no question of current account for that company. And if at all any company is having both current account as well as working capital loan, the bank, Reserve Bank of India also instructed all the banks to close that one. And even banks also instructed to the branches to close that account and credit that current account to the working capital. Otherwise, some penalties are imposed to be imposed by the banks to the branch managers. A bank name board should be displayed where the securities are located, stating that bank charge over. Even though all these precautions are taken, still the mismanagement today, the company is not overnight failed over a period of time. They will simply divert it, they will misutilize the funds, then only later it was the financial creditor filed the application with the NCLT. It is not a sickness. So many companies diversion of funds, diverted the funds and turn into and a liquidity problem arises, unable to handle, then they defaulted. Defaulted means the turn into non-performing. Non-performing means immediately they can approach the DRT earlier, now IBC, or compromise or OTS like that. Recurring inspection should be conducted by the banks. See that the level of goods being maintained in the same way one declared by the borrower as per his books. Borrower should submit stock statement. Particularly in hypothecation type of loans, the borrower has to submit the stock statement because it is a mobile one. How many stocks are there? After that, the stocks are with the bank finance or any credit also provided. If credit also provided, that is to be deducted. Any non-mobile or obsolete stocks deduct. After that, margin remaining is the eligible amount to withdraw from the bank loan. And such stocks are to be insured fire and other risks. So, as long as the stocks are there, that is to be insured properly. If at all anything happened during CIRP, the insolvency profession is held responsible. Held responsible. Now, the another one is LIN, lien. This is also one type of charge on the secured assets. Secured loans, the assets are provided by the borrower. Lien. Lien is a right of one person retain the goods of security in his possession, belong to another certain legal debts, person releasing that. In other words, right of the creditor to retain the goods and securities in his possession belongs to a debtor until the debt is due is paid. Lien does not give power of a sale, but only retain the property. Even banks, we are giving loans on fixed deposits. Once the loan on due date it is not paid, the fixed deposit to be cancelled and credit to the loan account. So on that fixed deposit, we will mark lien. The borrower is not eligible to cancel or to withdraw that particular fixed deposit. Particular lien. Section 170 of the Indian contract defined the particulars of a particular lien where the bailee has, in accordance with the purpose of the bailment rendered by the service involving the labor or skills, whatever it is there. The particular lien is confirms the right to retain the particular commodity in respect of which a particular debt arose. As long as the loan is there, the fixed deposit to be continued. Once the fixed deposit, the loan is due and the borrower is not paid, the bank will use the authority to cancel the fixed deposit and credit to the loan account. But bankers are having general lien. Bankers are having general lien. But that is also defined under 171 of Indian Contract Act. Only the financial institution, bankers may have absence of a contract to contrary retain the security of for general balance of account any goods billed by them, but no other person has a right to retain as a security for the balance of the goods unless it is an express contract to them. Only bankers are having that line. What is the general in? Simple example. Simple example I will discuss. Suppose I have taken one overdraft loan, 1 lakh. At the same time, I have taken a loan again, the loan on gold, 1 lakh. Immediately, I have paid, after certain days, I have paid the gold loan account, and the bank is going to deliver the gold to me. In the meantime, bank verified what are the various loans that are available, that are availed by the borrower. Then that is overdraft account is there, overdraft without any security. Then the gold they need not give to the borrower. They are having a right as per general lien, as per section 170 of the Indian Contract Act. They don't give. No, first you pay the overdraft also. Then only I will give the, I will, no, sir, I have paid the gold loan. You give the gold. Later on, I will pay. No, bankers are having a general lien that is under section 171 of Indian Contract Act. A general lien confirms the right to retain the goods securities not only in respect of particular debt, but also in respect of a general balance due the owner of the goods securities in the possession of them. That's why bankers are having powerful lien that is called general lien, bankers lien. So whenever, even though the borrower securities are there, the securities are not released by the bank in case other loans are not repaid. That power is available to the bank, that is called banker's lien. As a general rule, the right of the lien does not give any person exercising the right, any power or right to sell or dispose of the security retained. But in case of bank, it is otherwise. A banker's lien is more than a general lien. It is implied that a pledge and the banker has a right to sell the property after reasonable notice, provided the property comes into his hands in the ordinary course of a business. Suppose a gold loan is there. Gold has to be delivered once the loan is closed or amount is paid. But no. Under section 171 Contract Act lays down, banker's lien can be applied if property in the hands of the banker as the capacity of the customers of the bank. The instrument of money, goods with the bank are not for the specific purpose inconsistent with the lien. The possession of the instruments has obtained lawfully by the bank, not forcibly in general business transactions. So the existence no implied or expressed agreement contrary to this law. Negative lien is also there. Whenever we are giving loans, particularly the corporates, take for example, one corporate has taken 10 crores stock loan and they hired one godown. The godown monthly rent is 5 lakhs. The godown is given rent on hiring or for the rent to the corporate. And whenever the rent is not paid, the owner of that particular godown is having a right to take the possession of the goods up to payment of the rent, till the payment of the. That's why when the godowns are, I have given loan 10 crores, bank is given loan 10 crores stock loan, and the stock loan also not the stock loan given. In the meantime, what was happened is the rent to the particular borrower, the rent to be paid by the borrower to the who has given the premises of that owner, then he may sell the property also, that stocks. That's why banks are insisting negative lien letter from the owner of that particular godown. Okay, in case of rent is not paid by the company, I don't touch the goods financed by the bank. That is called a negative lien. So the negative lien is to be taken by the bank. At the time of advance is made, the banker sometimes asks the borrower to execute a letter of declaring that his assets are free from any sort of charge or encumbrance. The borrower also undertake the assets stated in the said declaration shall not encumbered or disposed without bank permission or in writing so long as the advance is continued. This undertaking is known as negative lien. Usually, arrangement is drafted in the form of agreement. The banker cannot directly release his debts from such assets. However, on account of the above restrictions, there is an intermediary between the bank and this one. Bank is also having a right to set off. The company is having a current account. The company is having a working capital loan. Now the company is going to face the CIRP. So whatever the current account balance is there, that can be credited to the working capital loan. That is called right to set off. Right to set off. So the right to set off a provision is also there to the bank. Set off is a right of the debtor to take into account of the debt owing to him by a creditor when claimed debt is a creditor. In case a banker has a right to set off, enables to adjust the debit balance of the customer with any balance outstanding in a credit of the books. In other words, the banker can adjust the claim from the amount that is payable. Suppose take for example, before submission of the claim to the particular the insolvency professional IRP or RP. If a credit balance is there, 1 crore, and loan amount working capital is 20 crores, they will set off the 1 crore with the 20 crores and the remaining 90 crores only they will give. They will submit the claim to the particular the IRP or RP as a claim. So that is called right to set off. The banker is having a right to set off. Whatever the credit balances are there, the credit balances are to be whatever the credit balances are there, that is to be closed and credit to the debit balances account, that is loan account. So far I have discussed the various charges that are used by the bank. Now I will discuss about the third party guarantees. On account of third party guarantees only, the personal guarantor to corporate debtor product is released by IBBI. IBBI is having released so many products. The first product is the corporate insolvency resolution process. The second product is liquidation process. The third product is a voluntary liquidation process. The fourth product is the particularly pre-packed insolvency resolution process. The fifth product is a personal guarantor to corporate debtor product. So these are the various products. In my opinion, all are event management only. They have clearly defined the time schedule. Before the time schedule, this activity or event to be completed. As an IRP or RP, you have to follow the guidelines, regulations. Beyond all these things, the professional conduct also is very important. The professional conduct. And once we are violating the norms or regulations as defined by the IBBI, then disciplinary action to be initiated by the IBBI on the recommendations of the disciplinary committee. Even small issues also, they are imposing some penalties for wrongdoings, etc. So third party guarantee. What is a third party guarantee? Even though primary security is there, collateral security is there, third party guarantee is also there, still loans are turned into bad. To strengthen the loan provided by the bank, they are going for one, primary security. Second, to strengthen the loan, they are obtaining collateral security. Third, to strengthen the collateral security, they are creating charges with SRO in case of vehicles, SARSI in certain cases, RTO, Regional Transport Officer, in the ROC, Register of Companies, in certain cases, or particularly RTA, the transport authorities, regional transport authorities also. And finally, the banks are also obtaining third-party guarantee from the promoters or the directors, etc. Today, the promoters are also reluctant to sign on the guarantee documents. The personal guarantee to corporate debtor is serious. If the bank is unable to recover the amount, then it is a big problem to the person guarantor to corporate debtors. The balance amount to be recovered or simultaneously earlier, once CIRP is over, whatever the shortfall amount is there, the shortfall amount to be recovered from the guarantors. Today, that is not the case. Today, not the case. Today, the case is along with the CIRP, the financial creditors are also filing personal guarantor to corporate debtors simultaneously. Not only that one, earlier, the CIRP to be handled by one IP and PG to CD to be handled by another IP. Today, that is not the case. Today, that is not the case. What they are doing is that both are to be handled by the one IP only. Otherwise, the communication documents, all these things, the perfect man is those who are handling CIRP is the correct man, because he collected the data widely, and the PG to CD is a small portion of the information. But here, the biggest problem is once the personal guarantor to corporate debtor arises, most of the guarantors, they are telling, I don't have any asset. I don't have any asset. Some people, they are reluctantly told, declare insolvent or bankrupt, no problem. So in that scenario, it is a big challenge for the RP or IR. It is a big challenge. Particularly the ascertain the assets of the third party and the guarantors. Most of the cases are not resolved within the time schedule given by the IBBA because it is very difficult to get the asset particulars. For that, one source, important source is available to the resolution professionals is the opinion reports or net worth statements. Opinion report or net worth statement. Third party guarantee means not only the directors or individuals, sometimes other company may give guarantee also. Guarantee means without providing any more immovable property or with immovable property also. Once the CIRP process or the CIRP process is continuing and personal guarantor to corporate it are simultaneously continuing, thereby whatever the assets provided by the guarantor to the company loan, that is also to be auctioned. Then only some of the cases are separated. No, they are moving to they are approaching the bank for compromise or one-time settlement like that. Okay. Again, the problem is withdrawal of application. Withdrawal of application after a request for resolution plan, it is very difficult. The percentage is also high side. So in that particular scenario, how to overcome the problem means by the IP. At the time of giving the loan, bank will definitely take the deed of guarantee. Today, they may not sign. Earlier loans, definitely they will sign. They might have executed the document and they signed the document also. So that opinion report or net worth statement is very, very important to the IPs in case of personal guarantor to capitator. What is an opinion report? Whenever the banks are taking any guarantee, either from corporate or from the guarantor or promoter or director, first they will compile the opinion report of the company or the director or the particular promoter, etc., etc. Whenever they are compiling the opinion report, as per bank guidelines, they have to get the full information about the assets and the liabilities of possession of the borrower. If the banks are asking assets and liabilities, they will simply give one white paper and put it, these are the assets, these are liabilities. That is not suffice. Even in State Bank of India also, they clearly told, whenever they are submitting the assets and liabilities statement, along with the proofs are also to be enclosed. If at all he told, I'm having a 20 lakhs worth of NSCs, National Savings Certificate, enclosed xerox. If at all you told, I am having 10 acres of land worth of 10 crores, enclose the document. And if at all gold, all these things are there, we are not insisting, we are not taking that as an asset also. Why? Because at any time they can dispose it off, they can melt and they can they sell it. That's why even cash we don't take, bank balance we don't take. So the opinion report at the time of giving the loan, to avail the loan, whether a director or the promoter, they will give certain accuracy of information. So when the personal guarantor to corporate debtor situation arises, and first of all, you ask the financial creditors to provide the opinion reports that are compiled by the bank along with the enclosures. Then you will get an idea about what are the assets, what are the loans, all these things. That is very, very, very important. And in certain banks, they are asking net worth statements. Net worth statements means the guarantor's net worth or the company's net worth. So the net worth statements are to be signed by the chartered accountant after verifying the assets, the liabilities, the tax obligations, all these things he will verify and he will give, or he will sign on that particular net worth statement. In the net worth statement, he should not mention simply he is having this much net worth like that. The proofs, with the help of the various document he has to prepare, that net worth statements are very much required. So these net worth statement or opinion reports are useful. And today, the third party guarantee loans, the directors or promoters, they are worrying about their personal properties. Earlier, they will approach the different courts. Some promoters, no, this property not belongs to me, that is belongs to my wife, that is Stridhan or that, then like that they are telling, and they are filing a case against that particular and struck. No, today that is not IBC prevail over all other acts. So that's why the opinion reports the banks are compiling, net worth statements they are getting from the chartered accountant for the proposal. But the worth of the guarantor, the worth of the directors, or the worth of the corporate guarantor, all are mentioned in the terms and conditions letter. The terms and conditions letter provided by the particular the bank, that is to be signed by the banker, that is to be signed by the guarantor, that is signed by the borrower. Borrower means the corporate entity, those who are executing the documents. So this document is also helpful in handling the PG to CD. Before concluding, most of the important documents are available with the banks. The purpose of this class is also how the bank is processing the loan, what type of a document, what type of charges they are creating. If the IPs are having some rough idea about this one, they can interlink or cross-checking with the bank's information available with the financial creditors. This is you are handing the CIRP on behalf of the financial creditors and operational creditors or class in creditors. The important committee is COC, Committee of Creditors. Definitely, whatever the information that you require, first you get it from the financial creditor. Once the financial creditor is having that information that is authentic, or in case whether it is authentic or some instead of a zero, something is better than zero. If at all, take for example opinion report. The borrower is asking, borrower is telling, I don't have any asset. At the time of giving the loan, you have mentioned all these assets. What is the present status of the asset? And anyhow, he is giving that Xerox copies, that is also available. Even if you write to the sub-register officer or even online also, while taking the encumbrance certificate, whether the property is in his name or another name, that also easy to get it. So that's why this type of information, the total credit information, total credit information of the business entity, that is a corporate data entity, is available with the bankers. Day to day, they interact with the GST statement, income tax statement, financial statement. Even if at all it is not supported by your staff members, the bankers will provide. They are the committee of creditors. You are there for it to recover their amount. And whatever the information, it is not a confidential one. That too, it is for the purpose of recovery of, no, not recovery. The IBC, we should not use the recovery. The resolution of that particular loan, definitely he will support. But once you got the assignment, if the financial creditor is filed that particular under section 7, the first and foremost, you verify or you request the concerned financial creditor, telephone, sir, can I have the terms and conditions of the loan and the appraisal note of the loan? Definitely they will provide. Then you will read that terms and conditions, you read that appraisal. Day one, you will get the full information. The appraisal, the bankers are preparing, covering all aspects of the company. With that, you proceed further. With that, you proceed further. Whatever the deficiency, whatever the shortfall information is there, get it from others. But prima facie, to have an idea, the appraisal note also, from starting to ending, the company, when it is formed, what is the registration, who are the directors, what is the, all particulars are available, what is their business figures, the past, the future predictions, what type of securities they have going to offer, what is the third party guarantee, how many, all information, directors, DIN numbers, all are available. Then it gives more comfort to the IPS. Not only this one, if at all you are having some doubt with regard to PUFA transaction, PUF transactions, then what are the observations while submitting this proposal to the higher authority by the banks, that they are willing to file that case with NCLT means they will give a beautiful report to the higher authority by stating all the facts. How the company turned from healthy to bad. All information is available. Have a look. When the company is in healthy position, when the funds diverted, and in the diverted funds also, as per bank knowledge, where they have to put all these things. And when the stocks are not there, up to what date the stocks are available, all particular information is available. Then it is a very, very easy for you to handle the case in a easy manner when compared to we are in dark. Because at the day one, whenever you are handling the case, you may not get the full information. Most of the people, they know the partial information. But to get the full information, the application submitted by the borrower for the banker to avail the loan, the bank proposal for giving while giving the loan, and whenever they are sanctioned, the terms and conditions of loan, these three documents definitely is gives good results. Not only that one, take day one, the commercial civil, wherever the loans are there, all are reflected in the commercial civils. And how many loans, they may not mention the name of the financial institution, but a loan, the limit, the date of sanction, the present outstanding or irregularity amount, all these things below, which bank is extracted that a civil report earlier. So most of the loans are in that particular bank only. So information straight away, straight through process is not possible. We have to use our strategies to get the information. Yesterday, I told about the pre-sanction, sanction, and post-sanction. There also some documents are useful in CIRP. Wherever it is the useful, I enlightened to you also. Today also securities, whether it is a primary security or collateral security or various types of charges or hypothecation or lien or assignment or the equitable mortgage or pledge. Because once the loan is given, as far as possible, banks will tighten to improve the safety of the loan. So, if you know all these things, definitely some good results, that is effectively and efficiently to handle the case is possible. If at all we are in dark, then it is very difficult for us. What is going to be happen? How many loans are there in this company? And one side, you have to continue the company as a going concern company. Other side, you have to handle the various people, particularly the creditor, operational creditor or financial creditor. But in most of the cases, to my knowledge is concerned, the operational creditor claims or financial creditors are not properly verified. Once it is properly verified and submitted to the appropriate authority, later on problems will not arise. Whenever the operational creditor submit the claim, the proof of the claim, the documents. Suppose one person is a operational creditor, he supplied raw material to the company. Then he submitted on a standard format. Had I been there in your position, first I will ask, where is the bill of exchange? Whether it is signed by the corporate debtor or not. The second question is whether the amount is mentioned tallied with the claim or not. Third question is whether the bill of exchange is stale or live within 3 years or not. Second one is once the bill of exchange is there, to that extent, the invoice to be raised, whether invoice, whether GST calculation. If a GST amount is there, this GST is tallied with the GST, the statement submitted by the company or not. Immediately this to be this creditors list, whether the same amount is reflected or not. Once the goods are sent by the transport, where is the transport document, Xerox copy? And once the goods are received by the company, they will acknowledge goods received note. And once the amount is not paid, in that particular this one, any interest to be paid for a delayed payment. Next, whether if that is a the creditors are the creditors that the particular creditors, some of the fraudulent creditors are submitted, that is to be verified properly. Whether it is a correct credit or not, that is to be verified properly. Then only the quality will increase. The last point is the debtors. That is also one good asset. If there is stocks are there in the balance sheet, but physical stocks are not available, what is the problem? Where it is? When it is lifted, who lifted? If you ask the financial officer, CFO, and can I have the insurance policy for the stocks? Which company? When it was this fund, particularly the stocks are insured. Whatever the stocks, the closing balance stores ledger is there or not. Who is the storekeeper? Because here, everybody is overview they are doing, not in detail. That is in detail is required. Once the case is there, they are touching and they are taking the services. Before that, you should be equipped with the knowledge. End to end. Because you are designated as a chief executive officer of the company on account of a failure of a repayment to the financial creditor or operational creditor, etc. That's why whatever the day before yesterday or today, I have given only the rough idea. It doesn't mean it satisfies all the requirement. But whatever the knowledge I am having, particularly the banking knowledge, I have disseminated in a structured manner. Today, I discussed about the securities, the primary security, collateral security, because you have to submit the form, the claims admitted, not admitted, secured or unsecured, if secured, what type of security. If we know about all these things, definitely some results. And if at all anybody is taking the services, but finally we have to cross-check or cross-verification to be checked and signed by us only, not by others. If at all any problems are arised, then it will be a problem. whether it is a first charge or second charge, or mortgage of deeds. Even today, some of the documents are time-bound documents also. They are submitting, and some IPs, they are admitting the time-bound documents also. Time-bound documents means they are not eligible. Okay, with this, I'm concluding today's deliberation. And another 2 days class is there on Monday and Tuesday. I will discuss some more aspects, particularly with the lending process only, the credit management process, and vis-a-vis how it is related to or correlated to the insolvency and bankruptcy code while handling the corporate insolvency resolution process or pre-packed insolvency resolution process. With this, I'm concluding today's deliberation. Thank you very much for your patience listening for the last 3 hours. Thank you, sir. Thank you, madam. Good night.
Thank you, sir.